So tonight I'm going to do my best to disavow you of the idea that you should be scared, afraid of the stock market. In fact, I'll show you how you're actually already in the market. First, a look at why. Why do so many people focus on the bad times, on the bad news and the bad headlines, and how that's making them miss out on all the good times? Business psychologist Dr. Jim Taylor is here to join us in San Francisco. Dr. Jim, why is it? Why is it that we focus so much on the negative headlines and we don't see the good things around us, particularly things like the stock market going up and the housing market going up?
Well, Charles, there are three forces that I see at work in explaining why people are reluctant, if not downright terrified, to get into the market. First, our most essential instinct is survival, and fear has ensured our survival for millennia. For as long as we've been around, when we're scared, we run away from it, and we're more likely to survive. But, Charles, times have changed, that we rarely come across saber-toothed tigers or rival tribespeople on the streets of New York or San Francisco or even Peoria. So what at one point ensured our physical survival now can threaten our financial survival. Second, we base our information on, we base our decisions based upon the available information we have. Unfortunately, these days in financial news, and as with most news, if it bleeds, it leads. And so people are bombarded by bad news about the economy in general and the stock market in particular. And it's only natural, without a counterbalance of all the good things that are happening. And it's only natural then, if all you hear is bad news, that you're going to say, I'm not going near it.
Right.
Finally, a fundamental tenet of classical economics is that human beings are rational actors, that we do things to maximize benefit and reduce costs. But 20 years of research has shown that we are, in fact, if not irrational actors, we are at least non-rational actors. We are victims of what are called cognitive biases. And cognitive biases are the tendency to process and interpret information and make decisions in illogical ways. And one of the most common forms of cognitive biases are what's called loss aversion. And loss aversion involves the fact that we are more concerned with avoiding loss than getting gains.
Right.
So this prevents us from taking reasonable risks. And as you well know, the reality is that the stock market has demonstrated itself to be historically a very reasonable risk.
More than a reasonable risk, but to your point, you know, local news broadcasts in New York, they call me every time the market's down 300 points or down 400 points, but when it's up 200, up 400, no one's calling, no one wants to know. And also the point you made about information being out there. This is the information age. I got to tell you, Dr. Jim, it's an amazing amount of information out there for people who are watching, so that can't be an excuse. Tonight, it won't be. Thanks a lot. We appreciate your expertise there.